Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, March the 26th, 2025, recording this in the morning. Okay, so the market seemed to be a little bit in a sort of a holding pattern. Obviously, we have sort of, this key date, it seems April the 2nd for, Liberation Day for the tariffs. Yesterday, Trump gave sort of contradictory signals. He said on one hand that, definitely there would be sort of more tariffs coming on copper. There would be tariffs coming, sort of quite significantly on April the 2nd. On the other hand, he said that, maybe it would be sort of moderated, reciprocal, depending on the country. Canada might be on the low end. So there's a lot of confusion, uncertainty, and it seems to me that a lot of markets are literally just waiting until April the 2nd to get some kind of clarity. That certainly seems to be the case of the business community in terms of investment. That's what some of the Fed speakers are saying, that they're hearing from their local contacts, that a lot of sort of investment is being put on hold and major decisions are being put on hold. And we're also seeing that, let's say, the consumer also seems to be sort of under a little bit of concern, shall we say, or just a little bit sort of nervous and a bit stressed. So if we look at yesterday, for example, we had the conference board readings, and it's interesting just to look at that. That was actually pretty low. So you see here, just on the left here on the chart here from the Daily Shot, US consumer confidence deteriorated further this month. So you see here, the survey was coming in at 94, came in at 92.9. So definitely consumer confidence seems to be going down. Again, the conference board survey is not the most exhaustive and perfect thing in the world, but nonetheless, it does seem like expectations, as you can see here, also sort of moving down. You see income higher or lower in the next 6 months, also moving down. Another question was, do you think there's going to be more jobs versus fewer jobs in the next 6 months, all moving down? So you see that overall the trend does seem to be, we're also seeing this in the University of Michigan, that the US consumer is still spending, but does seem to be losing some degree of sort of confidence in the future. We also see the dimmest outlook for personal finances. You're seeing that was moving down. On the other hand, it seems as though the consumer, you see here for 1 year inflation expectations moving upwards, and you see, for example, automobile purchase expectations moving down. So overall, it seems that both in the business investment community and in the personal kind of consumer community, at the minimum, we could say there's a bit of nervousness and decisions are being put on hold. A little bit more pessimistic would be to say that there is indeed quite a lot of pessimism. So Trump needs to get this sort of organized, and as we say, April the 2nd is when there will be clarity, and maybe the clarity in itself will be a good thing. But what we're seeing, let's say, in the stocks, if we look at the ES, for example, at the SP 500 futures here, they had a couple of nice days, nice bounce, but now you see this, it's becoming a little less momentum. You see yesterday, virtually no movement, similar kind of situation in the NASDAQ, still sort of grinding upwards a little bit, but no real sort of upwards momentum. And it's just interesting. This is the continuous contract, and we're getting up towards, the 100-day moving average, which is this orange line here. We're also getting some horizontal sort of overhead resistance, I'd say at about 58.75. Now, in theory, we've cleared the 200-day EMA, but what is interesting just from a technical perspective, that's on the continuous contract, but if you actually look at the front contract, which is June, it's a slightly different sort of technical situation here. And you see that on the June contract, which is the prompt contract, you see that it's a lot less sort of positive in a certain sense. Well, obviously, we still have this bounce, but what you can see is that the Fibonacci retracement here, just at the 38%, we have this horizontal overhead resistance, is always at about 58.38 now. So basically where we are. And also kind of importantly there, the 200-day exponential moving average on the front contract is here, or basically at resistance. Now, it's always tricky from a technical perspective to say, oh, no, I'm going to go with the continuous contract, which kind of stitches together all of the back prices and adjusts for sort of gaps and whatnot, compared to the prompt contract. But, we only had the roll a few days ago, maybe a week ago or so. And so it does pay attention. Normally, I look at the continuous for the longer term trends, but it does, I think, it is warranted, it is justified to look at the front contract, just to look at that and wonder if the market maybe will sort of just pause here a little bit and just use that as a bit of an excuse, just waiting for clarity. Now, in terms of clarity, as I say, yesterday we had the consumer confidence kind of numbers. Today we do have just a couple of data points. We've got the durable goods coming up at 8:30, so in about an hour or so. That's quite a choppy number, but the reality is the market is trying to gather all information from the consumer point of view, from spending point of view, from inflation point of view, but also the real economy. So in terms of the real economy here, we do get the preliminary numbers for February. We're now at the end of March, so you could argue this is slightly sort of stale data, but nonetheless is interesting. As order, apart from the headline number, probably the key one the market usually sort of focuses on is the capital goods excluding non-defense, excluding aircraft, and ships, excluding aircraft. So these two here, and excluding transportation. So not so much the headline numbers, but the numbers excluding transportation. That is considered well. The survey, the consensus is for 0.2. So like a modest boost. As I say, this is kind of a choppy number, but just interesting to see whether that confirms any sense that the U.S. economy is doing strongly, or could it be a shock and be otherwise. The other thing is that it's just interesting for me, just looking at something like the VIX here. If we look at volatility, because volatility has come down. I think I put that up on the video yesterday. If we actually go into that, just give me a second here. I'll just bring up the VIX curve. So we'll go into that, which is vol and VIX futures curve. So for sure, if we compare this to, let's say, a week or a month ago, let's say a week ago, you could see that it was still a week ago slightly in sort of backwardation. The actual futures curve was flat. Now, in a slightly less volatile situation, market sort of paradigm where the market is a bit more relaxed. Normally, historically, that should be in a contango. So the front spot price should be lower than the curve, which should steepen the more we get out. And that's what's actually happened in the last week. So you could argue that's a positive. But it's interesting to me to think, well, okay, it was now at about 17 and a half. Could that go lower? Because if we look at the futures contract, the VIX, the first VIX contract here, and I'll just go into that. I think it'd be X. And let's just look at the April contract. You can see here that we did have a spike up to the mid-20s. This is on the daily chart, and we've come back down now. So we're down to about, on the VIX contract here, about 17.9. Again, slightly different. That's a month out compared to the actual spot VIX itself. But you've got to say that, anything, if this gets a little bit lower at about, let's say 17.5, something like that, could be interesting just to buy, let's say, call spreads or even outright on the VIX future here, just on this idea that there is still quite a lot of volatility in the air, and that Trump's announcement, yes, one could argue that's going to that's going to provide clarity, but it also could provide a substantial amount of sort of volatility as markets reprice and readjust. This, it could be anything from, sort of tariffs on car imports coming in from Europe to Canada, some of the sort of emerging markets, like Brazil, Vietnam, these kind of countries. So I do believe that it's going to be difficult for volatility to actually significantly go down over the next sort of week or so. So I think, as I say, if you get a price at, let's say, 1725, 1740, 1750, that could be an interesting one, because I don't really, I think the chances of volatility, collapsing over the next few days are minimal, just because we have geopolitical risk still happening. We have attacks with the Houthis. We have leaks from the White House about the Houthi attack. We have a lot of sort of problematic situations with Russia, Ukraine. Obviously, the situation in the Near East, in the Gaza Strip, is not anywhere near being resolved. So the point being that until and unless we get clarity, maybe even in a positive sense, from the White House on tariffs, I do believe that sort of long VIX in some shape or form is maybe an interesting thing to be looking at. Okay, the other sort of big thing which is happening today, actually probably relatively soon, is in the UK. We have the Chancellor of the Exchequer, Reeves. Excuse me, just grabbing some tea. Giving the budget statement. Now the problem there is that if we actually look at the yields, we can see, where are we? So if we look at the UK sort of bonds, this is on the price here, just the generic 10-year. You can see that basically over the last 2 to 3, 4 months, the gilts have sold off quite a lot. And you see, for example, at a budget speech similar to what we're getting today, basically on the 1st of November, you see that the gilts sold off quite a lot. And ever since then, they've kind of been grinding down. And basically the idea here is that there's not a huge amount of sort of space, fiscal space for the UK. They're very heavily indebted, a lot of expenses, and basically the yields have gone up about 50 or 60 basis points sort of recently. And that is just creating more sort of fiscal sort of headaches for the chancellor to try and balance her budget. And so, really, the numbers which everyone's looking at today is that for the financial year 2025 and 2026, and as I say, she'll present these numbers very shortly. The market's looking for a gilt supply of about 302, 304 billion. So 302, 304 billion pounds in terms of the gilt issuance. But there is some fear in the gilt market or in the bond market that if that number is more like 317, 320, something like that, or even 325, the idea is that the gilt market may not enjoy that at all. And the so-called bond vigilantes, who you'll remember came out with Liz Truss a few years ago, are very sort of keenly looking at that number, which is going to come out from the estimate of the issuance. If that's the case, and that number is up to more towards like 315, 320, 325 billion pounds, that could put a lot of downward pressure on the UK gilts. And also that could actually put a little bit of upward pressure on the yields, which also could spill over, is my point, into maybe the German bonds and bunds, and also maybe into the US. So there's something to look out for is headlines. Now, in terms of the pound itself, the pound tends to be trading because it's an open economy. It doesn't like this sort of loose fiscal policy. And what we've seen is that the pound actually, it doesn't really like these sort of high yields is sort of considered a lack of sort of a fiscal sort of discipline. So if we actually look at the pound, I'll just put it on the futures here. You can see that the pound has actually been up against the US dollar, just kind of hovering around a little bit. We did have some slightly lower than expected UK CPI this morning, so the pound came off a little bit on that. So it didn't like that at all. And if we get sort of too much issuance in terms of the gilts, the pound, at least historically, has not enjoyed that at all. And you see there's a lot of this big sell-off here in sort of November, December. Obviously, that was due to strengthen the US dollar, which is kind of a separate thing. But also this was due to the fact that the bond and the FX market perceived that the UK government was not being fiscally responsible enough and was basically sort of issuing gilts at far too fast a clip. And so that's the point. If we get, as I say, that too much bond issuance, from Chancellor Reeves, Chancellor of the Exchequer Reeves, we could actually see the pound sell off as well. So that's definitely something to be looking at in the next few hours. Okay, in terms of other stuff, just talking about bonds, if we go over and look at the US market here in terms of the bonds here, let's look at the yields. We can see, I mean, essentially kind of trading in a sideways pattern. We know what the Fed is saying. The Fed is saying that they're not going to cut anytime soon. They're probably not going to hike. They are waiting for more clarity. For sure, they will cut if there's some incredible deterioration in the labor market and in the real economy. But until and unless we do get that kind of data, which we're not getting, they're doing nothing. And we had a Goolsbee, I think, was it this morning or last night, basically that his base case was maybe Bostic, sorry, I beg your pardon, Bostic saying that he had penciled in 2 cuts, but now he's only looking for 1 cut in 2025. So the point is that the front end of the curve here is just kind of grinding up, grinding down, a bit headline driven, a little bit data driven, but really we're going to have to see a substantial clarity about the tariff sort of policy, and secondly, just where the US real economy is going in the next few months. So it's just grinding sideways. If we look at something like the 10-year, the yields are going up just a little bit here. So we're seeing a bit of a bear flattening here. So you see the 10-year yields and the 30-year yields grinding a little bit higher. So they are going up higher, maybe in anticipation of the tariffs, or maybe the fact that the real economy seems to be doing okay. But at this point, no huge moves. What is interesting is that yesterday we did get the 2-year yield, the 2-year auction of the bond auction. That was pretty successful. So no problems there as such. There's still demand. Today could be a bit more interesting. We have the 5-year auction at 1 p.m. Again, as you see here, just going to the 5-year yield chart, just grinding sideways in a range. And as I was saying, I think on Monday, in the Monday video, this is not really, there's nothing much to say, to be honest. We have to wait until we get more clarity, as I say, about the sort of Fed policy, the real economy, and obviously the tariff situation. What is also sort of interesting, though, is a little bit just look at the metals market here, because if we look at the metals, we see that gold looks like this mini sort of dip is being bought. There is a constant sort of demand for gold. We know that it got to the top of this channel about 3,050 on the spot, has come down a little bit. It looks like buyers are sort of coming in again and grinding it higher. But what's kind of interesting is also just keep an eye on the gold silver ratio. And you can see here that this is the gold divided by silver, which actually is one of the world's oldest indicators going back to the Roman times, where it was about 13 to 1, so 13 silver coins to one gold coin. But anyhow, we'll move on. But in the our sort of contemporary sort of gold silver ratio, you can see that it's been trading within this box, and it seems to be capped at about 87, 87 and a half or so on the downside, the ratio, and on the top side by about 92. So, and what's kind of interesting is that we're seeing that every time that the gold silver ratio is hitting that upward resistance of about 92, it does seem to be coming back down, which implies sort of outperformance by silver. So if this is going up, of course, it means that gold is outperforming silver, and on the way down, it means that silver is tending to outperform gold. And in fact, if you look at the silver price, so now we'll just go back to the silver price. Actually, we'll put it on the spot here. You can see that it's had a couple of days, when it hit that sort of overhead resistance on the gold silver sort of ratio. You can see that silver's sort of trying to test up again recent highs. This is all supporting, so in these sort of precious and semi-precious metals, this is also supporting copper. Copper is actually really interesting at the moment. There's a lot going on in the copper market. So as I've been saying for a little bit, traders are literally flying into the US enormous quantities, tens of thousands of tons of physical copper into the US in an effort to front run potential tariffs on copper coming in the next few months from the Trump administration. But what was it? And that's part of that has been this sort of big sort of a push up higher in the COMEX price, which is in the US, which is different to the London Metal Exchange. And so, but what we're seeing here is that just from a technical perspective, we see a Fibonacci extension here. It looks as though it's sort of ending, so it's starting to get a bit overextended, and we're also above this recent high going back to May, so about 7 months ago, of about $5.2 per pound here. But what we got overnight, we did get some sort of leaked story from Bloomberg from the White House saying that our copper tariffs could be coming not in a few months, but actually very soon, in a matter of 1 or 2 or 3 weeks. And so that caused a bit of a short-term spike up in copper. So what's going to be interesting here is to say, is this just an attempt to front run the tariffs? Is this mainly priced in? Does this have more to go? Or is this just sort of a little sort of spike upwards, and now copper's going to sort of find it difficult to sort of push higher? And is this genuine sort of long-term demand? So is it like an arbitrage with the London market? And we can look at a couple of things here. I've just got a few little charts, which is sort of interesting, just to see a little bit what's going on in copper. So again, just comparing what's happening in London, because there's basically a premium being paid for copper, which is sort of physically present in the US. And normally you can see here the COMEX, which is the London price in, the New York price in blue, it trades in lockstep with the London Metal Exchange price. But as you guys can see here, for the last couple of months, they have decoupled, and the New York price is it's about 10 or 15% higher. What's also happening is that this is causing a premium of any copper within the continental United States. And what we can see here is that I just got this little chart here from Mercuria, the copper trader, or metal, in fact, metal traders, courtesy of Bloomberg here. Copper scrap exports plunge. So what we're seeing here is that copper scrap, and remember that the copper market, most of it comes out of the ground, but a good proportion is actually recycled scrap copper, which is very valuable. And what's happening is that because the premium of copper sort of literally physically present in the US has been rising compared to London or the Shanghai prices, we can see that the amount of copper leaving the States is actually plummeting. So there's no copper leaving. No one is actually exporting their sort of scrap copper to places like China. And the logic here as well is that eventually demand in places like China, other markets which are not in the US, that's going to be put, they will need copper. There's going to be a shortage, and that's going to put even more global pressure on copper. So the bulls are saying this is actually could cause a second wave of copper price to go up. So there's less copper going into places like China. It's all going into the US. And one example of that is the amount of scrap metal which is leaving the US, which is basically zero at this point. Now, the other interesting thing here, some people, an interesting kind of chart, again, got this from the Daily Shot. Paradigm Capital. Interesting from a much longer term perspective, looking at gold here, you see this kind of sort of cup and saucer formation here, sort of a rounding bottom long term, and then having the big gold breakout, which we know had happened. And, the copper bulls are saying, well, hey, is this, sort of a similar thing here? We know there's long-term structural demand for copper for electrification. Of course, in the Trump era, there's a lot of sort of pushback on, we love, a clean coal and, we love oil and all these carbon-based energy sources. But the reality is for most of the world, the medium-term sort of electrification of the grid and enormous AI, enormous sort of energy build-outs for AI and everything like that is there's got to be a constant demand for copper. And there does seem to be sort of a global shortage in terms of mining stocks. Anyway, so the point is here is that from a longer term perspective, more investing than trading, are we sort of witnessing the beginning of a sort of a pretty serious bull breakout in copper? Interesting to keep that in mind. The other thing as well, just a couple of other charts here, is I think I had a couple of copper charts up here. Yeah, I mean, just was this the one I had? Oh, it's just the copper price you see in London going up. But yeah, just again, looking at this spread here, you can see, again, it's a similar kind of chart here, just basically showing in the white. That's the HG, the high grade contract in New York. And you can see how that's been up, 29% compared to 15% in this time frame compared to the London one. So really starting to outperform that. And you can see here that the spread, just going back, let's say over the last year, we're starting to get at a percentile here, which is starting to get a little bit extreme. It still could have more to run, but that's definitely something interesting to keep our eyes on. Just in terms of some other stuff, guys, just want to have a look at the oil market here. Oil is doing quite well. There is, sort of talk of, as I said yesterday, sanctions on Venezuela, on Iran. If we just look at the curve here, yeah, just want to look at the curve. You can see that, again, in a nice backwardated state, pretty sort of steep backwardated state compared to, let's say, a week ago, as I think I showed yesterday. Also, the front price is coming up. And if we actually look here, we have the government sort of data today for the inventories. Let's see if they confirm what we got yesterday. Here we got this is from the API yesterday afternoon. So we actually had a draw in crude minus 4.6, which was better than expected, which is only minus 2.6. So we had a pretty sort of a constructive drawdown yesterday in the crude. Let's see if that's sort of echoed this morning at 10:30 by the US government numbers. Distillates minus 1.3, gasoline minus 1.3, and also Cushing. So basically all across the products and also crude, we have a pretty nice sort of drawdown, and that at the margin should sort of support the outright price for crude oil. As I say, we need to see that sort of confirmed or not by the official numbers. But if we actually just look at the crude oil, the WTI pricing this morning, where are we? There we go. So I'll put on the continuous contract here. You see that this breakout, which I thought could have been a sort of a negative sort of bear flag, actually is pushing higher. Interesting point here on the front contract. We're pushing up towards the 50-day moving average. Still a lot of work for the bulls to do, but we are starting to turn some of those very, very short-term sort of moving averages, the 5, 8, 13, which the market likes to look at. And here it's got the 20-day moving average starting to move those up. So, okay, so far so good. We shall see if there's any sort of drawdowns in the US government numbers this morning. And that's about it. Oh, just one thing. Oh, we looked at the currency. Well, we won't look at those too much. Not a huge amount going on. The euro and the dollar index pretty much stuck in a sideways pattern. I think that's it for this morning, guys. Keep an eye on copper. That's an interesting one. Also, oil. Remember that if the price of oil is going up at the margin, that could be considered a little bit inflationary for the US yields, and so they could start to put a little bit of upward pressure on, let's say, the 10-year yield if we do see more of a push upwards in the price of oil. Okay, that's it. Have a good day, and we shall no doubt be continuing the conversation throughout the week. Thank you.